Welcome to our presentation on Savings Basics, the quick and easy version, brought to you by rebelcapitalist.com. We are going to cover some of the more common savings options available to people. This is not a comprehensive coverage of the topic of savings, but it's a good start. Let's quickly go over what we're going to cover in this topic of savings basics. First, we're going to briefly discuss the problems with the U.S. savings rate. We're going to hit upon the difference between savings and investing. We're going to provide a few savings tips. Then we're going to cover savings accounts, checking accounts, certificates of deposit, money market accounts, and the difference between money market accounts and money market funds. So let's cover the problem with U.S. savings. The economists look at this concept of the U.S. savings rate, determine whether we are saving enough. The savings rate is the savings as a percentage of household disposable income. It's low, and in fact it was negative in 2005, which implied that we were borrowing money to cover our expenses because there wasn't enough savings. And I'm not going to bore you with the statistics, but rational people know when they're not saving. And I say rational people because if you're addicted to credit cards or spending, you're not rational. So if you know as a rational person whether you're not saving enough. Now there's a rule of thumb that says that 10% of your gross income should go to saving. I'm a little uncomfortable with providing that rule of thumb because each individual's case is different. I think the best thing to do is to set up a budget and make sure that you reduce your spending. This is an obvious statement. In the long term, not saving is bad, because if we're not saving and then we're spending, and if we're spending too much, then chances are we are borrowing to pay for that spending, which obviously is bad. Savings versus investing. There is a difference, but they are connected, and I'll explain toward the end. Savings relates to the preservation or protection of cash balances that we're accumulating, particularly in our checking or savings accounts. Another term for savings is cash management. At least that's the term I'd like to use. And investing relates to growing our money through investment returns, investing in stocks, mutual funds, our pensions, our retirement accounts. That is investing. Now, the reason why I said earlier they're connected, because if we are not saving enough, then we cannot invest. So let's cover some savings tips. The first one, and probably the most important, is to have a written plan, particularly a budget. Next is to research and compare annual percentage yields and terms on the various savings options such as checking accounts, savings accounts, CDs, because they will differ between financial institutions. And a good place to start online is Bankrate.com and Yahoo Personal Finance. Be consistent. Follow the plan. Make the plan a habit. Do it on a monthly basis. Make it automatic. Many employers provide direct deposit. We need to take advantage of that option. Some employers actually allow an allocation between a checking account and a savings account. We also need to take advantage of that. Pay yourself first. We hear this very often in personal finance. This means that you're going to make your savings allocation first before you pay your bills or you go to a show. You're going to pay yourself first. So let's cover savings accounts. Savings accounts are also known as passbook savings because when you go into bank, oftentimes they give you what looks like a passport with this faux leather backing. And I remember when I was a kid taking that passport-looking document to a teller and giving it to the teller, and they would mark or stamp my deposit plus any accrued interest, and I got a really big kick out of that as a kid. Today you have online savings accounts where you could open up an account online and you get a savings account usually through your sent to you through email. Savings accounts earn interest anywhere in the range of currently anywhere in the range of 2% to 3.3% annual percentage yield. And this is something that's often overlooked. They are limited by law. You are limited by law to 6 withdrawals per month. And it could be fewer depending on a bank's policy. And there could be penalties attached to exceeding those withdrawal limits. Checking accounts. A checking account is a deposit account that allows a written instrument called checks to act as cash that are drawn upon our account balances. Most financial institutions now offer a debit card and or an ATM card that is attached to a checking account. Some checking accounts do earn interest, usually very nominal interest. And we have to be careful. We have to read the fine print because oftentimes there are transaction fees, hidden or otherwise, attached to checking accounts, such as ATM usage fees or debit card usage fees, or if we're limited to the number of checks we write per month, or like I said, debit usage, you're limited to the number of debit purchases you could use with your debit card. I believe it's important to talk a little bit more about debit cards. Debit card transactions act like a check. They're not a credit card. There's no grace period when you use a debit card. In fact, money is deducted from your checking account sometimes within hours, at least within a day's time because of electronic transfers. And the purchase protection is limited compared to credit cards, particularly in the case of unauthorized charges and protest charges. So we have to be careful when we're using our debit cards. Certificates of deposit. CDs are time deposit accounts that earn a certain rate of interest for a set period of time. Common lengths are 3, 6, 12 months. They can be rolled over upon maturity into a new CD. And this is an important thing. Funds are locked in for the term of the CD. There is no early withdrawal without a serious penalty. Money market accounts. Money market accounts are deposit accounts that act like a savings account and a checking account in one. They act like a savings account because they earn interest on account balances. And they act like a checking account because you could write checks against the account balance. And importantly, federal regulations limit the number of withdrawals to 6 per month and no more than 3 withdrawals via a check per month. Now I think it's important to cover this particularly because of what we're hearing in the news today as it relates to the financial crisis. It's money market account versus a money market fund. They sound similar, but they are very different. A money market account is what I just covered in the previous slide. It's a deposit account. A money market fund is an investment in a mutual fund. Money market accounts are FDIC insured. Now, money market funds are insured by, because of the financial crisis, insured by the U.S. Treasury. That concludes our presentation on Savings Basics. Thank you for your attention, and please visit us at rebelcapitalist.com. Have a good day, and good luck.